So I'm going to do some intros while they're getting settled here. So again, I'm Chris Wetherbee, transportation and shipping analyst at Citi. I feel like I got like the Oscars music in the background playing to kind of get us off the stage, I guess. This is going to be a good panel. So we have the LNG shipping panel. This is one of, I think, the more interesting sectors within shipping right now, at least from an equity research analyst perspective. We're joined by three panelists. We have Harald Gurvin, the CFO of Flex LNG, to my left right here. Harald, thanks for joining us. Andy Orekar, CEO of GasLog Partners, to his left. Andy, thanks for joining us. And Majed Limam, who's a manager from Poten Partners. Thank you very much for joining us. What I'd like to do is maybe go to Majed first, because you have an interesting perspective on this, because we have a couple of owners and then we have someone from the consultant side of the house who's going to be a lot smarter than I am about this stuff. So I'm going to go to you first and you can help me out here. But if you could maybe start by giving us a little bit of your lay of the land about maybe the current supply-demand environment in LNG shipping. And when I mean current, like the 2019 type of story. And then we can kind of build out from there. I think that'd be a good way to start.
Yeah. Thank you for this opportunity. So yes, I mean, it's a very exciting time actually to be in the LNG industry in general, and of course including on shipping. The market has experienced tremendous growth the last few years, and we project it will continue to grow. And I'm talking about the LNG product itself. Which drives, of course, the need for LNG shipping all around the world. So just to give you some perspective, over the last 10 years, LNG market has grown in average, 7 to 8%. If you compare that to the oil market, that's only 1.5%. So LNG is a growth area. It's a good business to be in, and we anticipate the growth to continue. Last year in 2018, the market was around 312 million ton per year. We anticipate this year 340, and then by 2025, around more than 400 million ton per year. So what's interesting in shipping is that the world is becoming more flexible in LNG, and the key supply source is coming from the United States. So trade routes are becoming longer. The need to ship LNG to further locations is increasing, particularly Asia Pacific from the US Gulf. And with that, the need for shipping is increasing quite high, paralleling the need for LNG. So in our view, the market currently is very seasonal. It's driven by winter demand in Asia Pacific. And as we see, we can have a market that is very tight, both on the shipping end and on the product, and a bit less tight during shoulder months, building into the need for winter. But overall, 2019 seems to be a year where you may see some tightness towards the end, and when the winter cold weather reaches Asia, and there's more requirement for LNG ships. There's 3 more projects coming out of the US, so that will increase supply. And into 2020 and 2021, we see a more balanced market.
Okay, that's great. That's a great overview. Certainly some sort of big growth numbers on the liquefaction supply side of the house. Andy, maybe I'll throw it over to you. Could you give us some perspective on supply from the industry? I'm going to have some company-specific questions, but maybe how do you think about the supply from the industry building today? What's sort of available from an open ship perspective now, and then maybe if you look out, let's flip the calendar over to 2020 and think about the supply environment then too.
Sure. So first of all, thanks for having me, Chris,
and
Nick, and the folks from Capital Link. Really appreciate the opportunity to be here. And would echo my fellow panelists' comments in the sense that we are in right now a seasonally quiet period for LNG, both on the cargo and shipping side. Our view is that this is very much transitory and will change as we get into really the second half of 2019. And what we've seen from a supply perspective, the last time the market was weak from a cargo pricing perspective, you saw relatively weak spot shipping rates. You didn't see a lot of ships being ordered. And in the last year or so, there's been a more active order book, but it's really kind of catching up with historical averages. And so today there's about 110 ships in the order book that'll deliver over the next 3 years. Roughly 2/3 of those are already committed on long-term contracts. And as you might imagine, the closer you are to a ship's delivery date, the more likelihood that ship's going to be on a charter. So in 2019 here, we've got 38 ships delivering, 33 of which have charters. And in fact, our parent company, GasLog Limited, just in the past month or so has announced 2 charters of its the 2 new buildings that were open, one to Endesa and one to JERA. So that we can't speak for the entire industry, but that is not uncommon given the size of capital investment you're making in an LNG ship, and I think generally is GasLog's strategy to have ships chartered before they deliver. So the overall supply for ships this year is relatively relatively static given how many of them are under contracts. Today, in the spot market, I would estimate that there's about 30 ships that are essentially dedicated to spot cargoes. It's not always the same 30 ships as multi-month and multi-voyage charters begin and end. But it's a relatively small number that you saw over the holiday period when a few cargoes were delayed getting into Asia. You had a number of ships sitting off Singapore waiting to discharge cargoes, and the market went from $70,000, $80,000 a day to a record high of almost $200,000 a day. So you don't need much additional tightness with a relatively small number of ships to move the rates. And so my crystal ball isn't perfect, but we feel quite strongly that Q3, Q4 will be a fair bit stronger than we are today and have every reason to be similar to what we saw in last year's market.
Yep. Okay. That makes sense. Harald, let's get you involved here. You have a decent amount of new buildings on order. So maybe the question for you would be, I guess 2 things. First, if you were to place a new building order today, when would you expect to get that ship? So what does the yard flexibility look like or availability look like? And then when you think about, from a Flex LNG perspective, how you like to balance committed capacity versus potential speculative new build ordering, how do you think about that approach as a company?
Well, I think if you look at Flex, I mean, we started out with basically 2 vessels beginning of 2017, the new mega type, and then come fourth quarter last year, we have a fleet of 13 vessels, which are basically all uncommitted on compared to long-term charters. We have 4 vessels on the water currently, and then another 9 vessels coming over, 2 this year, 5 next year, and 2 in 2021. I think our take has always been, we want a mix of long-term contracts and some on shorter term. But we just feel the timing hasn't been right to fix out the vessels exactly for the reasons we we discussed here with all the capacity coming online. I think if you fix out the vessel today long term, it's not the best of business return on capital wise. So we've intentionally waited with fixing out the vessels and let the others fix first. And then when the market is really tight this year, I think we're definitely gonna look at some longer term opportunities. It's also a bit down to the fleet we have. Of course, it's all 5th generation, ordered at very attractive prices and with what we believe is fairly attractive delivery slots. Some of them have full relic systems, which are very suited for longer term charters. There are 3 of those coming next year. There we see a lot of interest for more longer term charters. But I think what a lot of people forget in the market you're seeing today is sort of the utilization. People read the headline rate, the TC rates, and they multiply that by the number of vessels and number of days. But of course, the TCE, the time charter equivalent, is what is really important. And in the market we're seeing these days, you can read the headline rates, but what you're actually earning is a lot less unless you get up the utilization. So I think we would also, in addition to more longer-term fixed contracts, we would also be willing to trade sort of a flexible rate under a longer-term contract where it's linked to the market, just to ensure you have utilization. So maybe not a fixed 5 or 7 year charter, but with flexibility in it. So, but you know, we're with 13 vessels currently, you know, unfixed long term, we're definitely not going to stay a spot operator with 13 vessels.
Got it. Makes sense. Majed, you talked about some big growth numbers on the LNG side. What are the risks to that developing over time, according to the schedule that we see when we kind of look at the sort of the longer term projections? And then if you were to sort of bucket any of that into what's probable and maybe what's a little less probable to come online, how much potential volatility could you see in that annual growth rate of supply of liquefaction capacity coming into the market?
Yeah, very good question. I mean, it is an industry that is driven by the supply projects and their timing. But what in turn pushes or kind of anchors the development of LNG projects on the supply end is the demand. So it's typically it would take 4.5 years, 5 years to build a liquefaction project. So the demand, there has to be some clarity on demand going forward. The largest risk, I would say, goes with the largest opportunity right now, which is China. China has grown tremendously the last couple of years beyond everybody's expectation, even ours at Poten. We had some aggressive growth, but they even overshot that. And that is driven by environmental decision by the government, which is we have to replace coal using gas, reduce emissions, particularly in large cities, particularly in the north, for heating purposes. And this has been really a big success story, but it's driven by the weather. And it's also driven by political decisions by the Chinese government to push the environment. Because from an economic perspective, it's very hard to displace coal. I mean, coal is the cheapest product to generate electricity in China. So it is a political decision driven by the environment. So markets, developing nations like China, India, the political decision and will to continue pushing gas to improve the environment at the detriment of coal is key here. Because if you look at the growth level going forward on LNG, it's driven by power generation, it's driven by Asian markets, particularly China and India and other emerging ones. And there the competition is really coal unless there's push from an environmental side by these governments. So what we do is we watch very closely all the progress from a political perspective, and China's been making a lot of positive moves on that end. India, a bit less so, much more complicated decision making. But those two areas, I would say China, India, emerging markets such as Singapore, Malaysia, Indonesia, from an import side, are really important development for the overall growth going forward.
Got it.
Yeah.
That's helpful. Andy, from your perspective, you mentioned the parent company has signed some recent charters, one of which was, you know, longer than what we've typically seen, and has diversified the portfolio from a customer perspective. What is the sort of term appetite from charterers? Is there a reason why we're starting to see things kind of pick up now as you look out over the course of the next 6 months or so? Do you expect to see, you know, maybe more activity, whether it's at GasLog or other partners, in the term market?
Sure. Well, I think there's a couple different dynamics. As mentioned, so much of the gas continues to be sold on such a long-term basis.
Yeah.
I'm thinking of Cheniere's deal with the Taiwanese for 25 years, and there was, you know, once a narrative that those long-term SPAs were going to go away. That actually hasn't happened. In fact, they're probably longer in term. And so matching the shipping or at least managing the risk as far out as you can with shipping from our customers continues to be very important. And so I think that the term business will be there for some time. I think for the on-the-water ships, you're competing against a new building that is 3 years away. And so for the on-the-water ships to get term deals that are much longer than 3 years, I think that's fairly unlikely.
Yeah.
There's probably some good circumstances where that still will occur, but I would say the majority will be less than that period. But for the new buildings, I think there's been a tremendous amount of capital discipline. Owners like ourselves and others want a de-risking of the investment they're making. And so from the new buildings that we're building and others are building, it's still 7+ years. And as you said, the last two that we've done as a company were 8 and 12 years.
Yeah.
And so we're very comfortable with that model. That's kind of our capital allocation model as well. And hope it continues, but a little shorter for the on-the-water ships.
Now, a question that may be a little sensitive from a competitive standpoint, but certainly let's just talk about your approach to returns on those assets when you're putting them out for long term. So we've seen asset prices historically, there was several years ago kind of peaked, and there's a little bit of a trough here. And so obviously you're going to match those contracts to sort of a return that you need to generate on the price that you paid for the asset. But what are sort of the broad pieces of the framework that you use when you're making those decisions?
Sure. So we saw about 15 months or so ago, it felt like a kind of cyclical bottom in the new building prices. And so we and a few others certainly placed orders at that time. And I think, you saw ships being built that were all in with supervision costs around $180 million, give or take. Which, if you look back over time, LNG, cost to build a new LNG carrier has been about $200 million plus or minus 10%. So not knowing with certainty, but feeling like that was a good time to be buying some assets. That's the last time we've placed some new orders. I think today that number is probably in the low 190s, really when it's fully loaded. Which again, I think those of us up here are probably delighted by because it helps our existing asset values, and it also keeps less well capitalized, less sort of scale entities into the business. And I think in each of those cases, we try to solve for about a 9 to 10% unlevered return.
Okay.
And so over time, again, big round numbers, that $200 million plus or minus new building costs would need a charter of $75,000 a day plus or minus as well. To generate that kind of cash on cash return. And I think our targets on that haven't changed. And so I think what we're seeing is as new building prices go up, the competition for term charters of new buildings is seeing rates move up very slightly. I think still in and around that $75,000 a day level, but it's going up with the ship costs.
Yep. Harald, do you have a perspective on how you guys think about that?
Yeah, we think 75,000 is pretty boring actually. But it differs because if you look at it, it's if you suddenly get to 85. That unlevered return is closer to 12%. So of course, if you have the muscle to sit and wait, and let the others do the 75,000, we think that the market is definitely going to be tight. So there's room for everybody. And I think you see now, of course, the market was extremely tight in the fourth quarter with rates at nameplate rate at $200,000 per day. Maybe the TCE was $300,000 per day because you could earn a double ballast bonus and charter that vessel out straight again. But then of course the market came severely down as in the first quarter. But I think the way we see it now, it's really bottomed out. But people still have fresh in mind what happened last year. So there's a big LNG conference in China this week. People usually get excited at these conferences. So you saw a lot of charterers wanting to fix vessels before the conference, basically taking it through the winter and securing the tonnage to avoid that spike. And the rates quoted there are fairly good, but with a bad spot market. So I think it's a strange situation now where you actually have usually it's the spot market that's driving the term market, but now it's actually people wanting to secure term that's maybe pulling up the spot market instead. But of course we have an ambition to charter out the vessels, but we don't have any. I think you see some of the companies, they need to charter out the vessels. Maybe they have covenants which means they need to have employment in their financings and things like that. We don't have any of those restrictions. We like to sort of make the decision ourselves on how we should charter out the vessels and not let the banks do that, because they usually want you to do it at the wrong time when the market is a bit low and they get a bit stressed. They say, you have to fix it. So I think, as I said earlier also, our stance has always been that, 19 and 20 will be very tight. And, we have the new fleet and the open vessels delivering at the right time. So it's definitely should be a good time to enter into more long-term opportunities. But at the same time, keeping some flexibility with some shorter-term vessels.
So what do you view as long-term? So what would be your perspective on a long-term charter?
I would say 5 to 7 years.
5 to 7 years, okay.
It's sort of a long-term charter.
And you feel like something in the mid-80s is possible, 5 to 7 years as you get through 2019, maybe touch into 2020?
Yeah, I think so. I mean, I guess there was a charter last year for 3 years at 105.
Sure.
Which we also bid for, but we were a bit too greedy.
It's okay. So let's stay here, Harald, for a second and talk about the sort of the sustainability of the spot market. What do you think we will see going forward in terms of the size of the spot market? Several years ago, no spot market. Today, there's more. Cargoes are being traded a bit more frequently than they have historically. What's your view there?
Well, I guess it's really a total change in the market, compared to the old 20-year point-to-point contracts, and then the second phase more the portfolio traders, and now it's LNG has really become a commodity. But still, of course, a large, as Andy also said, a large part of the contracts are long-term contracts. Mm-hmm. But you do see more and more in the spot market. I think for the fourth quarter 18, around 70% was long-term business. If you look at sort of ton miles, which is how you measure demand, and around 20% was sort of what we call the shorter term, which is below 3 years. How much of that was actually spot, I'm not sure, but and then 10% was sort of medium-term contracts. But I think if you look at what you're seeing in the market today, of course there's a lot of capacity coming out of the US. Where that capacity is going to end up is really what's going to drive the market. Right now it's mostly going into Europe, which is short ton mile. If it goes into Asia, as it usually does, that's double the ton mile. So we do sort of calculations on how many vessels is needed. I think if based on the 30 million plus tons coming this year, and sort of the average trading distance you have seen, our estimate is 60 vessels are needed against the around 40 vessels that are actually being delivered, many of which are contracted. If it goes into Europe, this gas, it's still a good ton mileage, but then it's probably more around 45 new vessels needed. So we do believe 2019 will be tight, and that's why you also see the sort of charterers now trying to secure tonnage before people get too greedy.
So, Majed, that's a great point, and one I wanted to ask. So, when we're translating our annual tons of production to ships required, are you using, I'll just ask it open-ended, what are you using for the next couple of years as you're seeing these trade lanes evolve?
Yeah, so, and it's Harold's got the exact point, is how much of the US is going to go to Europe, South America, and how much is going to go longer distances to Asia.
Yeah.
And in our view, a lot of it is going to Asia. That's where the demand growth is. That's where the need is. Mm-hmm. And if you look even at where the 100 million ton per year that has taken final investment decision out of the U.S., who the buyers are, most of them are Asian buyers or Asian trading houses with the original idea to take a lot of that volume to Asia. So in our view, yeah, a number like 60 to 70% going to all of east of Suez, which will include Middle East, China, India, Pakistan, Bangladesh, and then Northeast Asia is a good representative number. That has a huge impact on shipping, because if you're taking 1 million ton from the US Gulf to Europe or South America, one ship, perhaps, is a good rule of thumb. If you're taking it all the way to the Panama Canal or through the Suez to India, you're doubling almost that number of ships requirement to ship the same amount of LNG.
Yeah.
So that can make a huge difference on the requirement. Another interesting aspect, and we see it more and more as the US becomes the key supplier here to the world, is if you look at the 100 million ton that have taken investment decision in the United States, about 50% of that volume is being contracted to end user buyers. So these are the Korea Gas, JERA, Tokyo Gas of this world. So you could assume with clarity, you can determine how many ships are needed for that trade. The other 50%, which is about 50 million ton per year, are either aggregators, the Total, Shell, BP of this world, trading houses, Mitsui, Mitsubishi, requiring quite a bit of flexibility on where to take that LNG. And it's going to be driven by price and netback. And again, that flexibility on shipping and having the availability is key to be able to move the product. So we do quite a bit of analysis there, but in our view, yeah, numbers like shared by Harald are a very good base case. And if Asia takes more during the winter, then there will be even more stress on the requirement. So that seasonality aspect is another layer of complexity there.
Okay, so if I'm putting you on the spot, I'm saying 1.75 ships per million tons. Is that a fair number to use?
Historically, it's been lower, but with the US coming in now, we would say more like 1.4, 1.5, even 1.6.
Okay.
A lot of it is going to Asia.
Got it.
Which is a much higher average than what we've seen when the trades were shorter and less cross-basin type.
Got it. That makes sense. So let's talk a little bit about sort of financing availability and how you guys are thinking about sourcing capital. This is a bit more of a consolidated market than some of the other markets in shipping that I cover. Andy, you guys have an interesting setup with a parent company, obviously an MLP sort of below that. What do you think, sort of, I guess maybe two questions. First, from your perspective, what do you think your rough cost of capital is? How do you think about your cost of capital? And then in terms of other capital that has the potential to come into this market, obviously these ships are big and expensive and complex. Is there an area where we could get crossed up as investors, where we could see a rush of capital coming in that could catch us off guard, where you could see the order book maybe get a bit too heavy?
It's a good question. So right now there's various strategies. There are public companies like ourselves. There are some who have MLPs, some who have not taken that step, or just don't quite have the scale to do that. And then there are some private owners, like there are in other lines of shipping. I think we see our cost of capital, particularly by having an MLP that has continued to work, as sort of a high single digit on the equity side and kind of mid single digit on the debt side. And for us, in our allocation strategy, that cost of capital makes sense and works for us. In our business, I don't see sort of an unexpected set of entrants that are not already well established in shipping. I think there's a real value in operating the ships and having that expertise. And so I think a sort of financial backed with little operating expertise entrant, I don't think is going to be very competitive for the long-term contracts that all of us want to some extent, maybe some more than others. But I think will continue to be a big feature of the market. That if you're in the business, you're going to be competing for long-term contracts at some point. So, never say never, but I think the number of players is fairly clear, and I think the cost of capital generally in the world are going up a bit, which again we feel quite comfortable with given our scale and the platform that we have. I do think we've reached for a GasLog specific comment. I think we've reached a scale now with 35 ships between the two companies that While growth continues to be very important, I think we're happy with our position, and I think we're more focused on continuing to develop that sort of inbuilt growth that arrives as new builds deliver over the next 2 or 3 years. And really take advantage of these strong years ahead to recharter the ships that are already on the water and who have charters ending during that time.
Yeah. And quick, as we're running out of time, Andy, from a growth perspective, can you remind us what you think you guys will be able to achieve from a growth standpoint at GasLog Partners specifically?
Sure. So at GasLog Partners, we have guidance of 2 to 4% growth in our annual dividend, and right now that's paying almost 10% in the high 9%. So low double-digit equity return, and then and that's cash on cash, of course. And our parent has a target of doubling EBITDA from 2017 to 2022, so more of a growth vehicle, and we're well on our way to achieving that goal. So feel good about those two options in the GasLog family.
Got it. And Harald, you guys obviously have a lot of new builds coming on over the course of the next several years, so a meaningful amount of growth. But how do you think about that, I guess, in the next several years, and then maybe you think about as you continue to grow and mature as a company, what you think the growth opportunity is for you?
Yeah, I think we were quite early out ordering vessels when the others were sort of waiting a bit. I think it was important for us to get to a certain size, so you're sort of able to be in all three basins. 2 vessels that you had, that was too little. 13 vessels, I think, was good. We could have ordered more, but when everybody else started ordering, we thought, it's probably time to sit back and wait a bit and see how this develops. I think there is definitely room for more vessels based on what you see coming online. But I think for us for now, we have 13 vessels, 9 still under construction. So I think that's a good size to be at for now.
Got it. That's helpful. And we have about 30 seconds left. So Majed, I'm going to turn it over to you. We always like to know what spot rates are going to do. So why don't you let us know what you think spot rates might look like? Where can we see a peak this year? Can we beat last year's peak? And how about 2020?
So I think the arbitrage to Asia is going to open up. Prices in Asia are going to go up by the end of the year. There will be much more higher need for US and Atlantic basin trade to Asia, increasing shipping requirement and of course increasing the rate from what we see today, similar to the peaks that we've seen in 200,000 level when China surprised the market, maybe not that high, but you'll see a positive movement. Yeah.
Okay. That's a good way to end it. Majed, Andy, Harald, thank you very much for your time. I appreciate it.
Thank you. Thank you.